Hello and welcome to this latest weekly market recap for the week ending Friday, May 22nd, 2026. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and welcome to the show. Good to be back with everyone. Interesting week again for sure. S&P 500 finished higher for the 8th consecutive week. That's the first time we've seen that since back in 2023, so that was a good thing. But it didn't come without a lot of heartache earlier in the week. We had Max Payne from options. May options expired the prior Friday, and we always know that that can carry over into the early part of the next week. The Mondays that follow monthly option expiration Friday, that has been the worst calendar day historically since 1950, and it was down again this past week. So we're used to that. We warn our members about that. We had a lot of issues going into the end of the prior week, especially with regard to semiconductors, because there was so much in the money premium on many of those options that were going to be expiring. So a lot of that not only led to some weakness on the Friday a week ago, but it also carried into the early part of the week. Got a lot of folks worried about inflation. So we saw the 10-year Treasury yield, the 30-year Treasury yield, both moving up substantially in the early part of the week, but they did come back down later in the week, and that spurred a rally in equities. Small caps did well. We'll go through all those numbers in just a minute. So the Fed's still watching to see what's going on with inflation. I think that there are a lot of folks on the Fed that are hawkish, which I think is going to neutralize some of the others that are dovish. I think this is going to be a continuing battle throughout the year that probably leads to us doing nothing. I just don't see any change in rates over the balance of the year without some really strong evidence to move the needle in one direction or the other. So we'll see how all that plays out. Sentiment hit its lowest level in, ever, many years, ever. And so I want to show you a chart a little bit later on sentiment and what that low sentiment likely means for stocks. And then finally, I've got a really interesting segment I want to talk to you about at the end of the show. Many of you know I'm not a big fan of breadth indicators. They've just never really helped me in terms of calling the market. I think a lot of times the signals are probably should just be ignored. They're not reliable, and they work. Those that follow breadth indicators will point to the times they work, but not necessarily to all the times they don't work. And to me, there's a lot more of those. But I want to talk a little bit about that. And maybe give you a look into the S&P 500 that you haven't looked at before. So stay tuned for that a little bit later in the show. But let's go ahead and take a look at what happened this past week in the market, and we'll go from there. So transportation stocks back on a roll. I'll show you a chart. I was a little nervous. They were down around the 50-day moving average, some key support. They did start to turn back up, and that helped the Dow Jones set a new record all-time high. We'll look at that chart a little bit later too. Transport's gaining over 3% this last week. Small cap Russell 2000 had been underperforming for quite a while. That group jumped up 2.7%, so outperforming this past week, which was good. As I mentioned, Dow Jones setting a new record, gaining over 2% this week. S&P 400 mid-cap up 1.75%. And then we've got the NASDAQ 100 up 1.2%. And finally, the S&P 500 bringing up the rear, up just 0.9% last week. As we move into the sectors, you can see a lot of defensive, maybe a little bit more value-oriented, dividend-paying type stocks. So, we got to pull back, and I'm going to show you some charts a little bit later, but we got to pull back in areas like semiconductors. And then the rebound where we saw some of the indices moving back up, like the Dow, into all-time record high territory. That was not the case for semiconductors. They bounced. It was nice, but they didn't go back up to all-time highs. And we saw some of that money rotating into defensive areas, which is at least reason to think that maybe the market is thinking about pausing. I did mention to members in our weekly market report, which will be out tomorrow morning, that we are moving into a historically bullish period. So the end of May into the first week of June tends to be really strong. But I think with some of the signals that we're getting right now, with some of the money rotating into a little bit more value orient, I don't know if this, I hate to bet against a secular bull market. I say that all the time because just when you think that you've probably got a top at hand, the market just explodes and moves up again. But there are some signs that are suggesting, hey, maybe we're not going to sell off a lot, but maybe we're not going to just keep moving up week after week after week like we have on the S&P 500. So this is just a little bit of a take a pause and think about things. I mean, it's not bad. You can see most of the areas were up last week, including technology and consumer discretionary, both of which outperformed the S&P 500. So I'm not trying to say it was all bad, but when you look and you see three defensive groups leading on a week when the market went up, that does make me at least consider that maybe the market's moved quite a bit. We had some issues with semiconductors. They moved back up. We got NVIDIA's report this past week. Didn't really light a fire on the under the group. NVIDIA, in fact, pulled back after its report. So let's just take a deep breath and, be thankful for the gains that we've had. And let's take a look and, keep an open mind as we go into next week. Down at the bottom, you can see communication services, really the only group that lost ground last week. Materials was in the red, but minus 0.02%. So essentially it was flat. So communication services, the one area of the market that was a little bit weak last week. Moving on, let's take a look at some of the key charts that I wanted to show you. So let's start off with the Dow. One thing I wanted to point out, and this is the case on many of the key indices and sectors, the AD lines really strong. I mean, here as we break out on the Dow to a new all-time high close and a new all-time high intraday, we did it with that AD line moving back up to new highs. I do like that. We do also, though, still have a negative divergence. So we have mixed signals for sure. S&P 500, if we do get back up and close above 7,500, it's very likely to occur with a negative divergence on the weekly, or excuse me, on the daily chart. So that would be a little concern. It's kind of playing into what I was just talking about with defensive stocks leading. It's suggesting maybe the market needs a little pause. And if we do go up this week, because of the seasonal tendencies and so forth, I want to see the nature of that strength. Is the strength continuing to rotate into defense, or are we seeing the semiconductors, grabbing the market and just dragging it to all-time highs again? I think that will tell us a little bit of a story too. But just keep in mind, if the S&P breaks out this week, we do have a negative divergence, which indicates that momentum could be slowing a little bit. It's just price momentum. So doesn't talk about volume. This does not have any volume in the signal. It is simply saying that the price momentum is slowing. Well, of course, we went up so fast. Price momentum almost has to slow. I don't think we're going to continue to go up at that rate. So it could simply be that we go sideways, maybe continue to slowly move up while that PPO tries to move back down again. We'll see. NASDAQ 100, again, look at that AD line, just absolutely soaring on this move to the upside. And there was the NASDAQ pulling back end of last week. And then, of course, the beginning of this past week, those 3 days. A lot of it was on gap downs, though. I was pointing that out to members last week. So I think some of it was orchestrated by market makers. Lower prices, cut down on a lot of the option premium they had to pay out. I think they saved a fortune on this pullback at the end of the prior week, plus the weakness that we saw on Monday and Tuesday. But then we did recover into the end of the week. You can see challenging the all-time high. Didn't quite make it there, though, on the NASDAQ. Russell 2000, big week last week. You can see the big move off of the Tuesday low. Went all the way back up, got very close to challenging its all-time high. This is a group that I do think, we had a negative divergence already. And we went back down and challenged price support. We didn't get down to the 50-day, but we did challenge price support. And that PPO has fallen quite a bit, not all the way to the center line, but we have unwound that divergence a little bit. So be interesting to see if the IWM breaks out. I think we have a better chance of sustaining that move to the upside. Small cap, or excuse me, mid cap 400. We had a bounce, not quite as good as the small cap. Still got a ways to go to get back to recent highs. And you look at the AD line on the mid caps, not quite what we're seeing on the other major indices. So it doesn't really seem to me like this is much of a push to the upside. And this is a topping head and shoulder pattern, by the way. Equal shoulders, equal the neckline on left side and the right side. So very symmetrical looking, very easy to spot. Moving up left side here, left shoulder, left side of the neckline. There's your head. Here's the right side of the neckline. There's the right shoulder. So if this group were to move back down, just watch those recent lows down around that 650 area. Transports, this is what I was talking about, came down to that 50-day moving average, put in a double bottom. We had struggled up here in about the 19.5 to 20,000 range. So when we came back down, it made sense for that area to act as support, and it did. And now we're starting to turn back up. So transport's looking much better than what they had looked really over the course of the last few weeks. I wanted to mention the technology group because technology, of course, now has grown to be about 36, 37% of the S&P 500. So whatever's happening in technology really has a major impact on what happens with the S&P 500. And also, obviously, with the NASDAQ 100, it's over 50% of the NASDAQ 100. But that AD line looks great. And here you can see we did actually break out to a new high in technology, even though we didn't in semiconductors. So it was the other areas of technology that was leading the group to the upside. All right. I wanted to point this out. So I mentioned at the top of the show that sentiment fell to its lowest level in history. Here is the University of Michigan consumer sentiment. And you can see that it dropped down to 45, 44 and change. That is the lowest. I mean, I'm going back all the way to since the beginning, back in 1978. This was the lowest reading. So if you're thinking, wow, things are really bad out there, just be careful assuming that means the market's going to go down. In fact, if you look at almost every one of these lows and look at where they occurred, here in 1980, here was a drop down just above 50. Look at where we were. We never really went any lower in the stock market than that. If you look at this low, which was down just below 65, this was 1990. Right at the bottom, that was the Persian Gulf War. We had a slight recession, and the consumer sentiment dipped to a very low level then, right at the market bottom. And then you look over here, 2008 into early 2009, we had these readings in the mid 50s. That occurred right near the market bottom. Then in 2011, we came back down to about 55. Guess what? It was right at the market bottom. And then what about 2022? We hit a low, probably it looks like maybe around April or May. So it was probably this low. So it didn't coincide with the bottom that ultimately hit in October, but this came after we had already had a lot of negativity and the market had already dropped probably close to 20%. It was probably already in bear market territory or very close when we printed that low. And so now here we are again at the low. The one thing that's interesting though is the stock market's at an all-time high. So it's almost a pretty significant disconnect there between the sentiment, consumer sentiment, and the way consumers feel about things and what the stock market's telling us. I thought it was kind of interesting, but the key here, in my opinion, is that normally this is a what's the word I'm looking for? Not reversal, but it is kind of a reversal signal. If the market's going down and we're seeing a lot of consumer sentiment, that usually marks a bottom. Contrarian, that's what I wanted. Contrarian indicator. So when you see a lot of consumer sentiment weakness, a lot of times that's suggesting that we're probably going to head in the other direction. And that has been the history. Notice also, where was the highest reading in history on consumer sentiment? Right at the market bubble top. Consumers don't get it. a lot of times it's the media that's feeding them. And so at the end of that massive run to the upside, remember, nothing was going wrong. I mean, you could throw a dart and make money back in 1999 into 2000, and then all these bottoms. A lot of times it was despair when we had those sentiment bottoms. So this is interesting with this new all-time low consumer sentiment reading, with the market already at an all-time high. Semiconductors, I just wanted to point out here. So we were talking about, and I know we talked about this with our members at Earnings Beats when we did our Max Pain event. We always do that the Tuesday before the third Friday. Third Friday is when options expire. So we always try to look a few days ahead of time to say, okay, where are all the in the money calls and puts, and which way would the market makers benefit by money moving to the downside, to the upside. There were a ton of calls, and especially in semiconductors. And notice the last day before options expired, and then the first 2 days of the next week, a lot of the options get exercised. So if they get exercised, market makers are still on the short side going into the following week, which is why you can still have an impact, and why we do typically have an impact the first day or two of that following week. So the Friday, Monday, and the Tuesday, all of a sudden, out of nowhere, we get our 20-day test. And that's what I said the Tuesday before. We could just get a 20-day test. Who cares, right? Nobody notices. It's just normal. When you're trending up, you get 20-day tests. Well, that little who cares 20-day test probably saved market makers billions of dollars in payouts, and probably cost a lot of option traders a lot of money. If you were holding semiconductors and calls going into the end of last week and you exercised them, you probably know exactly what I'm talking about, because you probably lost a lot of profits. That is typical. That's the way the stock market works. This is what we explain to our members all the time. Anyhow, market bounced last week. We saw the Dow go to all-time highs, S&P, the NASDAQ moving up, not quite setting new highs. But with that, you can see semiconductors really didn't get back up to their recent highs. So if they pause and consolidate for a little while, that is likely to lead the market overall to do the same thing, even though we could see some money rotating into some other areas. 10-year Treasury yield, just wanted to point out, we had a big spike at the beginning of last week, got up almost to 470. We haven't seen 470, you can see, over the course of the last year. So that was probably spooking a lot of folks, but we did get a reversal over the last 3 days of last week, and we came back down, finished at 4.56%. Also, crude oil. So crude oil has been extremely volatile. Beginning part of the week, we were up around 106, 107, I think intraday. And by the end of the week, we had come back down and closed just under $97 a barrel. So energy has been extremely volatile because of crude oil prices. And of course, all of this relating back to the war and what's going on there. I don't have a crystal ball. I can't tell you when that's going to end, what's going to happen there. What I can tell you, though, is that we do have the market watching it every single day, and it's going to continue to react. And there's really no area that's reacting more violently or with more volatility than crude oil prices, that whole market, and energy, the sector. All right, a couple things here real quick. Number one, if you like the video, please hit that like button. Also subscribe to our channel. We do a lot of free events, and if you're subscribed to our channel and your notifications are on, anytime you're on YouTube, we start something, you'll be notified. So make sure you take care of that. It also helps us in the algorithms on YouTube. So even if you can't support us financially at Earnings Beats, that's a very simple way of helping us. Just click that like button and subscribe to our channel. Also, if you want to learn more about us, probably the best way to do it is through our free newsletter. No credit card required. Just name and email address, hit that subscribe button. We literally have tens of thousands of folks that have joined us on the EB Digest. I think it's packed with useful information, trading information if you like to trade. Of course, all the trades are completely up to you. They're your risk. But we do provide a lot of education, a lot of things that are important to us at Earnings Beats. Finally, one last thing I just want to mention. We are in the midst now of our spring special. So if you go to our website at earningsbeats.com, you'll see a link here. You can click on that and save $200 for about another week or so. So make sure you get signed up. If you have been thinking about it, there's really not a better time because of our spring special. You'll save some money and also hopefully learn a lot over the course of the next year, and we'll do our best to keep you out of harm's way. All right, last thing I want to do, and this I kind of alluded to at the very beginning, I wanted to talk a little bit about breadth. Now, you can measure breadth on the S&P 500 a lot of different ways. You can use the advanced decline line. You can have a cumulative advanced decline line. You can have bullish percent indexes. You can look at an index or a sector and then look to see how many stocks within that index or sector are above a certain moving average. And that's what I've done here. So I've got the S&P 500. Then down below, I've got the S&P 500% of stocks above the 50-day moving average, and then the S&P 500% of stocks above the 200-day moving average. And there are a lot of folks that will look at this and say, well, if prices are going up and the percent of stocks above these moving averages is going down, that means we got breadth concerns and we should be worried about what's going on in the market. And probably the move to the upside is not going to be sustainable. I personally have never really found this to be useful. After the fact, maybe, but not to help me call the market. So I don't really spend much time with breadth, and I want to explain a little bit, maybe, and look at the S&P 500 in a way that you may not have ever looked at it before. So let me, I'm going to unshare my screen because I want to show you an Excel spreadsheet. So I'm going to share my entire screen with you. And then I want to go in and let me pull up this Excel spreadsheet. So what I did to try and help explain a little bit better, I broke down the S&P 500 into the various sectors. So you'll see all the sectors over here. There's your 11 sectors. Now, these first two columns right here, what I did is I just went and calculated the number of companies in each of these sectors that are within the S&P 500. So if you total all of them up, you'll come up to 500. But technology, there are only 75 companies, which 75 is 15% of 500. So what I did is I calculated all the number of companies within each sector to give you an idea of the percentage of companies in the S&P 500 within each sector. So 15% of technology. You might be surprised, technology's third, even though it's by far the biggest in terms of market cap. In terms of the number of companies, it's actually third. You have more industrials and more financials in the S&P 500 than you do technology. Healthcare is not that far behind. You got 58 healthcare companies as opposed to 75 technology companies. Now, if we're looking at market cap, this is where we stand right now. This is according to market caps from Stock Charts. That was my source, stockcharts.com. I added up the market cap of all the companies within each of these sectors. And you can see 25.38 billion is the total market cap of these 75 companies. And then if you look at something like industrials and financials, even though they have more companies, they don't have nearly the market cap. And remember, the S&P 500 is a market cap weighted index. So it moves based on the bigger companies. The bigger companies have a bigger impact. Okay. So clearly the technology group, which is now 37% of the S&P 500, has tremendous influence. Only 15% of the companies are in technology, but 37% of the market cap is in technology. So when we're looking at breadth, a lot of times what we're doing is we're looking at the number of companies that are above a moving average or the number of companies that are advancing or declining, we're not looking at the number of, we're not doing it, we're not looking at it in terms of market cap, we're looking at it in terms of sheer number of companies. So it's, to me, it's apples and oranges. Why am I worried about a bunch of industrials or financials or healthcare companies? If you look at every one of the groups outside of these three aggressive groups, technology, consumer discretionary, and communication services, if you look at the other 8 sectors, their percentage weighting of number of companies is higher than their percentage weighting based on market cap. So industrials are more than double, which is the biggest margin. Well, actually, in terms of percentages, materials, 4.6% of the companies, only 1.5% of the market cap. So actually, that's a triple. But every one of these down at the bottom, industrials, financials, the percentage of companies is higher than their percentage of market cap. So when we're looking at all these breadth indicators, it's telling us a lot about all of these areas that don't carry as much market cap. It's just they have more companies. And I mean, what are you interested in? Let me give you an example. In 2018, that was when the communication services sector broke out. They became their own sector. So they took some companies from technology, they took some companies from consumer discretionary, and I think there was like a separate group, telecom equipment or something, that I think was a separate sector, and that was thrown into communication services. Anyhow, or no, it wasn't telecom equipment. Anyway, that was the time that it was broken out, 2018. At that time, technology, to give you an example, technology was 20% of the S&P 500 in 2018. It's now 2026. And now technology is almost 37% of the S&P 500. So technology's market cap is almost doubled. These are the companies that grow faster during a secular bull market run. So when you're trying to evaluate a secular bull market run, why do you want to do it by looking at companies that don't participate to the same extent in a secular bull market? You are always going to be doubting the move to the upside. It's just the way it is. When technology is really, really strong, like it is right now, it is literally, look at the S&P 500, the NASDAQ, just exploding the last 7 weeks because of technology. And you got a lot of breadth folks out there saying, well, we're lacking breadth. Do you want the market to go up? If you want the market to go up, you want technology to go up, because that's 37%. Looking at it another way, look at the market cap per company, average market cap per company in each sector. 338 billion is the average company size in technology within the S&P 500. If we look at materials, it's 45 billion. They're about 1/10 the size of technology. The only group that's bigger, has a bigger average market cap per company, is communication services, which is $406 billion. And during secular bull markets, these are the companies that grow the fastest. The economy is expanding. Interest rates are low. Future earnings are valued more. So the companies that produce those earnings are the ones that are going to get the market cap. You're not playing catch up in these other groups. They're not going to catch up during a secular bull market. They are always going to lag. So I don't really get the whole breadth thing. One other thing that I did want to point out is I took the top 10 companies in each sector. And what was the market cap of the top 10 companies in each sector? So there are 11 sectors. So it's 110 companies, 10 in each sector. So the number of companies is equal weighted. But what is the market cap? 19.3 billion in technology. The total is just under 50 billion. So that if you're looking at just the top 10 companies, technology is about 40% of all of those companies. So again, 40%, about 38.83%, is nowhere near 15% based on the number of companies. A lot of the breadth is going to be based off of these sheer numbers of companies. That doesn't correlate with the market cap. So, I mean, I could go on and on and on about this. I just don't personally see the benefit of breadth indicators. I think if anything, it holds you back. It gives you reasons to bet against a very strong secular bull market. Anyhow, have a great rest of your weekend, everybody. Hope you've had a great extended weekend. We get back to it Tuesday morning. We'll see what the market has in store, and we'll be back next weekend to give you the latest update. Happy trading, everyone.